Most married couples file jointly without a second thought. But what if that one small mistake can cost you tens of thousands of dollars? Let's talk about it. My name is Ryan Bakey. I'm a real estate CPA. My clients own over $2 billion in assets, and over the last 3 years, I've helped our clients save over $15 million in taxes. And in this video, I'm going to show you exactly when filing your taxes as a married couple can save you money, and when filing separately can actually save you more money. We're going to walk through 3 real-world scenarios that include debt to income, student loans, mortgage approvals, and income and deductions and credits on your tax return. We are going to do this with you in mind so that you can make the best decision for your specific situation. First up, let's talk about tax credits and deductions. So filing jointly usually doubles your phase-out thresholds. You get a much larger income brackets. You don't climb the tax bracket as quickly when you file jointly compared to married filing single or separately. And you also get to combine income. So this works really well if you have, let's say a high earning spouse and then maybe not so high earning spouse, but they're both married. Well, now that person who, if they would have filed single, would be climbing the tax brackets super quickly, now is not climbing them faster because they get to take advantage of the married filing jointly tax brackets. There is one credit that completely vanishes if your joint AGI exceeds over $1 million. And let's talk about some of these credits. So things like child tax credits, education credits, savers credits, all of those phase out at a certain AGI. A high earning spouse can push your joint AGI above these thresholds, wiping out thousands in benefits. By filing separately, each spouse uses their individual AGI. So if one partner's earnings are modest, they can still claim credits that would otherwise disappear once they combine joint incomes together. And you saw this a lot during COVID, where there was stimulus credits, there was government money given out to people for unemployment, and back then, a lot of times it made sense for people to file separately because they were scaling those tax brackets not as fast, and they were able to get those credits and deductions for things like kids, economic stimulus payments, etc. So let's say client John earned $190,000 and his wife Emma earned $30,000. So together, because their income gets bumped over $200,000, they miss out on $2,000 worth of education credits. When they filed separately, Emma qualified for those education credits and they were able to save the $2,000 on their tax return. So this is a scenario in which all else equal, they're actually better off filing separately so that she can get those $2,000 in education credits, versus if they were to file jointly, then neither of them is going to get the education credit. So deductions, education credits, something to consider when you are married and you're filing taxes. And this is probably best up to your tax advisor or your CPA when they're filing your tax return. Most our software has a button that we can toggle between married filing joint and married filing separately. So it's not like we have to recreate or sometimes do a whole nother return from scratch. Like sometimes we can just hit a button and it'll show us what your tax looks like if you were married versus married filing separately. Hey, real quick, if you're a real estate investor and you're looking for ways to stay competitive in today's market, I want to help you out. My team and I work with real estate investors to save them $10,000 to $50,000 in taxes every single year, and we currently have a few spots to work one-on-one with us to build your tax strategy. Our average client saves around $18,000 a year by working with us, and so if that's something you're interested in, then you can click on the first link in the description for more information. Okay, now back to the video. Next up, let's talk about student loans. Right, so we want to keep your student loan payments predictable. We want to make sure that if any forgiveness is out there, that you're going to qualify for that. If one spouse has federal, let's just say income-driven repayment plans, IDR plans, and then they combine that with another spouse's income, it's going to spike the amount of their required payments. So a lot of times on those government assistance student loan programs, your student loan is capped at a certain percentage of your income, right? And then whether it's forgiven or not, it depends. But if you combine income with a high earning spouse that maybe doesn't have student loan debt, well, now your monthly payment is going to be higher. So what if you could cut your payment in half without refinancing or having to defer anything? And that's why it matters, is things like IDR, repayee programs, they count joint AGI if you file it jointly. Filing separately forces the Department of Education to consider only the borrower's income, so the one spouse's income. So in this case, you might be better off filing separately than jointly, because one spouse has to pay a lot of student loans back. Now, you would obviously want to make a comparison of what the increase in income taxes would be by filing separately, right, versus what you would be saving in monthly payments on student loans, and work with your advisor to kind of figure this out. But this is one of the things that you want to look at, and it's a holistic overview of, does it make sense to actually do this, right? Because if you're married filing joint, then both spouses' incomes are going to feed into that calculation. But if you're married filing separately, then only the debtor's income is used, often slashing the monthly bill on student loans. So, we saw a scenario where we had Sarah and Mark, and they owed $1,200 a month under a repayee program. And by switching separate, Sarah was able to drop her payment to only $600 a month. So they were saving $7,200 a year annually by filing separately instead of married filing jointly, right? So this is a scenario in which student loans are definitely a scenario in which it might be better to file separately, especially if you're on some sort of government forgiveness program or some sort of repayee, like pay it back over 10 years type of program. Most of the time it's going to be better to file separately if you're on those programs. But as always, please consult your tax advisor. I may or may not be your tax advisor, but please definitely consult a tax advisor on this type of stuff. So lastly, let's talk about this. Home buying, right? Lenders scrutinize your debt to income ratio all the time. Joint filers must report all debts and incomes on one application. And can separate loops be the key to unlocking a better mortgage rate, right? Can separate returns be the key to unlocking a better mortgage rate? Let's talk about it, right? So why does it matter? High debts or obligations of one spouse can inflate the combined debt to income, right? Let's say one spouse has just crazy credit cards or student loans or car payments, right? Or compared to their income, right? And filing separately can showcase that, one spouse has, lower obligations than the other one, right? So let's say you might have a spouse, let's say Anna and Luis, and combined their debt to income is 48% because Luis's student loans are just absolutely crazy. And 48% is above a typical 45% lender cutoff like a Fannie and Freddie loan. But by filing separately, Anna's debt to income was only 38%, letting her secure a primary mortgage, right? So there's some times when filing jointly versus separately, it might make sense from a lending perspective. And so this is something you want to think about. So sometimes it might be better to file jointly. It might be better to file separately. Obviously, you want to check in with your accountant, check in with your lender to kind of see which ones make sense. I know for me personally, my wife has a W-2. She has an income, but I'm normally the one that goes on, any business loans, any real estate loans, any sort of loans where we really need show a good income in order to get the credit, just because her income alone isn't going to cut it, right? So when we're applying for loans, we normally put any sort of consumer debt goes in her name. Now we don't have a lot of consumer debt, credit cards, we don't have car loans, but we just have credit cards that go in her name, and then all like the hard assets are going to go in my name. Just something to think about. Before you rush to married filing separately, let's consider a couple of downsides. Number one, we talked about potentially a higher tax rate. So married filing separately makes you climb up the tax brackets a little bit quicker and faster than if you would if you're married filing jointly, right? So if you're going to do married filing separately for student loans, debt to income reasons, if you're going to marry filing separately, one of the things we didn't get to was like past debts, right? Like if you're marrying into somebody and somebody's paying alimony or they owe federal tax debt or they have all these other things going on with them, it may make sense to file separately. It might make sense to file separately so that the new spouse isn't on the hook for the old spouse's debts, right? But remember, when you file separately, you're going to climb up those tax brackets a lot higher than if you're jointly. We got to talk about lost credits, right? There might be credits that you don't get if you're married filing separately that you do get if you're joint, and vice versa. Another thing we got to talk about too is the complexity, right? Because if you have to file separately, then that means that there's actually two tax returns that get filed. You have the one spouse and the other spouse. And if you're splitting rental properties or you're splitting a business, that can be kind of complicated. So you have to see if it's actually worth it or not. That's why it's great, best to talk with an accountant who knows your situation to determine if married filing separate or married filing joint is better. Again, we just happen to, our tax software has pretty much an easy button that we can press that automatically splits the return, and it lets us know which one's more favorable, okay? So we don't really have to do as much digging to determine if it's favorable for you. So let's talk about, is filing separate right for you? Let's make a decision framework here. Does your combined income push you out of key credits, right? Those credits, those deductions, those phase outs. Does one spouse have a heavy IDR, income-driven repayment plan, right? If you have student loans, are you shopping for a mortgage and hitting debt-to-income roadblocks? My cousins just bought are under contract on a primary home, and for a long time their roadblock was one of the spouses just had a ton of student loan debt, and then it eventually took them to only apply under one of the spouses who didn't have any student loan debt but had a decent W-2 income, but they didn't have any debt. They were able to buy the house just under his name, right? Can you handle the extra complexity, right? So 2 returns instead of 1, separate books and records, separate bank accounts in some cases, right? If you answered yes to 2 or more of those, you may owe it to yourself to model out both scenarios to see if you can save a ton of money. Thanks for listening to the show today. If today's episode helped you rethink your filing status, hit subscribe and share it with your spouse or friends, because 2 heads or 2 tax returns are sometimes better than 1. Ready to see which filing status truly maximizes your refund and minimize your risk? My team and I offer a filing status deep dive session. We'll run the numbers, weigh the trade-offs, and give you a clear recommendation onto which one to do. Spots are limited, so head to taxstrategy365.com to apply.